let's talk about consistency concept. As the name suggests, it has a lot to do with maintaining consistency through particular processes in accounting. According to the definition, consistency concept requires a company to follow same accounting principles, methods, practices and procedures from one accounting period to next while making the financial statements. Assuming you know what exactly comprises of financial statements, I'll dive into the importance and uses of consistency concept. Let's take an example in order to make things a little more interesting. Mint Private Limited is a shoe company making and selling shoes throughout the country. They use first in first out method for their store in Mumbai, also known as FIFO method, and for the store in New Delhi, they use weighted average method for valuation of inventory. If you don't know what FIFO and weighted average method mean, don't worry. It's okay if you don't know for now, as here it's only important that you realize that they are two different methods. I'll make a separate video about them later. Now, the consistency method tells us that Mint Private Limited should not follow two different types of methods for valuing their inventory for the same product. This will make things very unclear in the financial statements when compared by the users of the financial statements. If you want to know more about the users of financial statements, check out the full disclosure concept video. I'll share the link in the description and also put it somewhere on the screen. Back to consistency concept. If you prepare financial statements without following one particular method, it becomes very difficult to compare, calculate, project, etc. as treatments for same transaction could be different in two statements or over two accounting periods, just like in the example. Now, there is another aspect of it as well. Although consistency concept prohibits Mint Private Limited to follow two different methods, it does, however, allows them to continue doing that if and only if they are done on reasonable grounds and disclosed fully documented in the financial statements. And that's the consistency concept.